There's so many problems with these kind of drawdowns, right? Because I think a lot of investors, they really can't stomach, probably once you start going much beyond 15% drawdown, or even certainly 20, I think a lot of people get very uncomfortable. I would say that I would also get rather uncomfortable because it's not really sort of what I would be expecting, right? You know, you got to have a certain type of investor and a certain type of manager who is able and willing to keep going, even if you are experiencing 25, 30, maybe even 50% drawdown. And I'm not sure how many managers and how many investors, you know, really sort of can pull that off successfully.
Most new CTA benchmark themselves against the B-Top 50 index, comprised of the some 20 firms in possession of more than 50% of the industry assets. These are the largest and most successful firms in this particular category. The question is, how does an emerging manager compete and break in knowing 80% or more of the available investor capital flows to these few firms? The good news is that all of these firms at one stage was also an emerging manager. Of the 20 firms in the index, 19 of them started with AUM less than $5 million. Interestingly, each of these firms had their best annualized returns for the first 3 to 5 years in business, returning on average 20% per year. Once their AUM grew beyond $500 million, their annualized return settled around 10 to 12%, and their correlation converged.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Around 3 months.
Yeah.
And currently we're allocating 50% across the 2 time frames, but we want to move to an allocation about a third in each time frame.
Mm-hmm. Sure.
Right. So again, sort of this philosophical perspective of an even weighting, right? Because the reality is that in our case anyway, the shorter term time frames actually have better risk-adjusted returns, higher Sharpe ratio,
Mm-hmm.
right? But we are sort of making a deliberate decision that no, you know, we want an evenly balanced portfolio.
Yeah.
And we're also looking at it from a scalability point of view. It's harder to scale on the very short term than the longer, you know, that kind of thing.
Yeah.
Then we look across the models, and we really have multiple models running right now, but they fit into 2 broad categories, I would say.
Okay.
Directional volatility and mean reversion models.
Okay.
Now, our core philosophical viewpoint or perspective is that we believe that the markets have directionality and that there are trends, and that's sort of our cornerstone, right?
Yeah.
That's we believe that that's the place for us to be. But we have done pretty extensive research, and we found that the mean reversion models actually can, on a standalone basis, actually make monies and have good risk-adjusted returns, and perhaps more importantly, they provide a more steady return stream and an inversely correlated return stream to the core directional volatility models.
Sure.
So we weighted those 70-30, 70 to the directional volatility, 30 to the mean reversion strategies.
Okay.
So when you look across portfolio risk, you have this situation about, okay, how do you want to manage your portfolio as the assets grow and the assets decline. Let's just say it has nothing to do with withdrawals or additions. It's just to do with the underlying performance of the portfolio. And in our case, the research that we've done and the decision that we made is that we will increase our capital allocation and risk proportionately as the assets grow, and we will stay static as you go through a drawdown.
Okay.
Right. So that's a decision. In terms of position risking, we look at underlying volatility in the markets. So we will position size relative to the underlying volatility of the market at any particular point in time. In higher volatility environments, we actually look to reduce our positions, to scale out of positions, and in lower volatility, we look to increase our position sizing.
So let me I just want to make sure I fully understand this. So are you saying that, as an example, you have $10 million under management, and when you go through the allocation, let's just say that coffee gets a 10 lot allocation based on current volatility. Now, if you draw down, say 10% or 20%, and volatility is unchanged, so all things being equal, you would still trade coffee at 10 lots. Is that what you're saying? Meaning that you keep the same asset allocation in doing drawdowns?
Okay, so you're talking about two things here, on the portfolio level and then on the individual market level, right? So on the individual market level, we will look to use a constant risk, and you're right, relative to the overall asset under management number, right? But so to use your example, if the volatility in the coffee market is the same, and in your example, at an AUM of 10 million, we were trading 10 contracts, and now AUM goes down to 9 million, and the underlying volatility of the coffee market is the same, then yes, we would be trading 10 contracts at that time as well.
It's very interesting because I've seen this before, and to some degree, I like that. I mean, I know a lot of people say, well, logically, if you have a smaller account size, you should trade smaller. On the other hand, we all know that if you believe in your system, then the best exactly, then you know that the best time to invest is when you're in a drawdown, and so I can see the logic in what you're doing by keeping it. Although I would say personally, this is just a personal observation, there probably should be a limit, meaning that there is a certain, because otherwise you could end up having a disproportionate higher internal leverage than when you started out, and maybe there is a limit in your system as well.
Nils, your observation is spot on, and I think you're exactly right. It comes down to your inner belief. If you really believe in what you're doing and your models and your portfolio construction, et cetera, then you should not be delevering, right? Because the best opportunity is during the drawdown, and you want the recovery time to be quick, right? You don't want it to be dragged on. So that's why you don't delever. However, there is a point where you have to say, well, there's something wrong here, right? And that's, for us, that is sort of along that is about this profiling, right? So that's where the historical simulation and portfolio construction and the correlation matrix and everything, all of that research come in, is that when you look at that and you go back over 30, 40 years or maybe more years, and you have that data, and you simulate it, and you build these portfolios, and you have a high degree of confidence in sort of in that interrelationship and the behavior of all these models, right? And your expectations are that the worst case scenario over those 30, 40 years is a 20% drawdown or something, right? Then I think you have to say that at some point, if you are exceeding those parameters, I think you have to then say that something is wrong.
Sure.
There's something wrong. I made a mistake somewhere, or maybe the world has changed so much it's possible, but there's something wrong. So that you have to pull the plug at, maybe 25% drawdown. You just have to pull the plug.
Yeah.
And that's sort of what we say to, that's what I've been saying to investors and prospective investors. I've said to them, listen, we're going to pull the plug. If that scenario occurs, it's either that there's something wrong with all of our research and our models and the portfolio allocation, construction, et cetera, or that the world has just changed so much and it's not working the way we thought it was going to work.
But when you say that, Kim, and to a large extent, I agree with you, but I also have to base my own 25 years of experience in this business and say, well, hang on a minute, because we've just been through a period of time where managers who've been around for 20, 30, 40 years, some of them saw their worst drawdown get exceeded by 50, some even 100%, meaning if they were historically down max 15%, suddenly they found themselves in a 30% plus drawdown. And so by any standard, I think the question would be, is this still working? And so on and so forth, as you just described. However, as we also saw in 2014, the very same managers, some of them had their best annual returns ever in their long history. And I guess by now, all of these big managers and the smaller one as well are making new all-time highs. So it's a tricky question because things can certainly get pushed out of whack, and you very elegantly described the convergent decisions by central banks a few years ago, which clearly created a unusual environment for these strategies, causing larger than normal drawdowns. But as a study, I think Aspect sponsored by people at Bath University, if you go back 100 years or however long they did, when you've seen periods of unusually bad performance, if we put it that way, usually after that you get a period of above average performance. So it's a tricky one, but I think at least there should be some steps written in the system that says if we go beyond our max drawdown, then we certainly can't have additional leverage built into it, or at least there needs to be some mechanism of deleveraging, I guess.
Nils, look, I hear where you're coming from, and you are indeed correct in the observations. And there's so many problems with these kind of drawdowns, right? Because I think a lot of investors they really can't stomach. I don't know, probably once you start going much beyond 15% drawdown, or even certainly 20, I think a lot of people get very uncomfortable. And I would say that I would also get rather uncomfortable because it's not really sort of what I would be expecting, right? So you got to have, you got to have a certain type of investor and a certain type of manager who's able and willing to keep going, even if you are experiencing 25, 30, maybe even 50% drawdown. And I'm not sure how many managers and how many investors, really sort of can pull that off successfully. I mean, I think what we've seen, I haven't studied it in great detail, but I think what occurred over those years is the tremendous amount of assets left, even these larger managers, really a lot of volatility in assets under management. And I think some of them probably also went out of business. But also you're right that the ones that did stick it out, they've been able to come back. But nevertheless, I think they came back with much less assets under management than what they had before.
Sure, and I think that is a very, very good observation and comment. And as you know, and probably as many of the listeners know, today I work for one of the most successful managers in the world, who have been around for 40 years and who have stomached a 50% drawdown along the way, but who have also outperformed most managers in the last 5 years, coming back and coming out of this. But at the same time, my good friend Jerry Parker at Chesapeake alerted me to, alerted me to a study or a comment at least about systems in general. I know it wasn't his own research, but something he had read, and I kind of, it escapes me right now what it is or who wrote it. But the conclusion was, and I actually tend to agree with that very much indeed, even though it's counterintuitive, and that is that the most robust systems are actually the ones with most volatility and big drawdowns. And that's a little bit counterintuitive, because everybody thinks if you can create something that looks steady and for all intents and purposes is steady, that must be very robust. But actually, their argument, or the argument in this piece of research, is that no, you want systems that has been through, rough times, and come out of it and survived over a long period of time, because they are themselves, or have indeed proven to be robust. So it's a super interesting conversation. Love to talk to you more about that. But right now, I know that a lot of people are dying to learn more about your particular strategy. So let me get back on track on that. Give me, one thing I found in doing this podcast, and that is people love examples. And if you're game, tell me a little bit, give me some examples of, what is a trend following model for you, and what is a mean reversion model for you? What do they look like? You don't have to be super specific, but what kind of indicators or whatever you might use goes into creating these models?
Yeah, great. So Nils, I think you teed it up very interestingly, because there is something very powerful in simplicity and the simplicity of a model. And I think there is a direct correlation between the simpler a model is, the more robust it is.
Sure.
And also, if the simplicity of a model that can be applied, and in our case, we insist on that it can be applied across multiple sectors and markets, and it has to be able to show that sort of robustness and consistency. I think all of those things lends itself to giving a higher confidence level, as opposed to a model that's very intricate and very targeted to a particular sector or market, right? So I think there's a lot of truth to that. Now, the conundrum is, if you make it very simple, and I believe that the earlier models were probably very simple, and they worked, and they continue to work. But I think the problem with these very simple models is that they have a lot of volatility in them.
Sure.
And so as we spoke about, I think the industry has just become much more competitive. And I think the investor is more demanding, and they want something that has better risk-adjusted returns. And so, to your point, can you produce models that are indeed superior, have better risk-adjusted returns, but have the same underlying robustness of the very simple models?
Sure.
And I think that's an excellent question, and a very interesting debate. So look, we've tried to tackle that, and it's a fine balance, because there's no doubt the more intricate you get, the better hypothetical results you can show. But the question is, how well are they going to hold up going forward?
Yeah.
So look, so part of the things that we try to do is that whatever ideas that we introduce into these models, again, they should hold true across a broad sectors and markets, and that the underlying idea should we say, sort of a value added component that shows its value, again, across multiple sectors and time frames and markets. Because then the conclusion is, at least from our point of view, okay, there's something here that appears to be robust and valid, and therefore it earns the right to be part of the model. Okay, so I'll give you an example.
Sure.
So you can look at market sectors and markets as having cyclicality, certain underlying cyclical tendencies, right? And you can therefore build the quantitative models and indicators that reflect the underlying cyclicality in each sector and each market, and you may be very comfortable with that, right? Now, we do not do that. Partly I think that the underlying cyclicality of the commodity markets have somewhat diminished over time. I think maybe historically there were more underlying cyclicality as the markets were more local and more concentrated, but many of the markets have become more global, and so the demand and supply is more spread out than it was in the past, and hence perhaps some of the underlying historical cyclicality that existed, particularly in the commodity markets, is not as prevalent as it once were.
Sure.
So we actually subscribe to applying our models on a non-cyclical approach across these various different markets and sectors. Now, another question that comes up is, okay, so you trade across multiple time frames. Well, how do you pick the time frames?
Right.
Should you optimize these various time frames, or should you not optimize them? What's your approach, right? So our approach was, again, not to optimize the time frames, and actually we are pretty indifferent as to these time frames, but where we are most particular is in the spacing between the time frames. Right. Because if you align one time frame very closely to another time frame, then you're really not getting all that much diversification between one and the other because they're so closely aligned.
Sure.
Right. And so for us, the most important thing was the spacing of these time frames.
Okay.
And because we don't believe sort of much in the underlying cyclicality of the markets, and we don't want to differentiate one market from the other anyway, we were completely sort of, I would say, arbitrary about, the time frames that we use in the models, and that time frame is the same that we use across all of the various sectors. Now, the other thing is that when you look at these components and these mathematical indicators, you can have them be sort of static in nature. A moving average could be a 50-bar moving average, as an example, right?
Sure.
And maybe a moving average can be parabolic, and it can be, can have different type of characteristics. But the bar number of bars is pretty stagnant. I think I think that is probably true for most of the models out there. And we like to think that's true because this is a point where we think we have an element of differentiation.
Okay.
In other words, we will split out our models across these relatively arbitrary time frames. But within the time frame, we have an underlying dynamic component so that this 50-bar example I gave you could be 50 bar sometimes. Maybe it could be 40 bars or 60 bars, and it has variability, right? So we have an underlying sort of components that help make these primary signals dynamic in nature.
So let me try and understand that. Sorry to interrupt you. Let me try and understand that. So if you're trading today, your models are choosing a 50-bar breakout model. Just use that as an example. That would then apply across all markets. But
Correct.
There is some element to that model, and maybe it looks at historic profitability as an example, so that 2 weeks from now, instead of using 50 bars, it might only use 45 bars.
Correct.
Okay.
And I'll give you more specifics in terms of how does it determine to whether it should be 45 or 60 bars. And for us, it depends on the underlying volatility of the markets, and all of that volatility, of course, can be expressed in many different ways. But we have sort of an approach to how we determine and calibrate volatility in the sort of most basic concept. We look at near-term volatility versus some historical volatility, and that gives us a gauge as to how to adjust this underlying time frame. And the objective, right? The objective for us is to try to get somewhat better traction and better accuracy in our primary signals.
Okay.
And we think that we're able to achieve that.
And so changes in volatility clearly can change the number of bars you change, and I guess, or you look at, and I guess there might be a range so that the longer term models can't go below 40 bars, for example, or I guess you need to, in order to keep the distance between the time frames in check, I guess. But
right.
Do they not look at historic profitability, meaning if 40 bars were really a bad profitable sort of time parameter to use, then it wouldn't use it? Or how do you balance between changes in volatility and profitability over time?
So we don't actually look at the historical profitability of the model.
Okay.
We don't. Maybe that's an interesting thing to look at, but we have not done that. The whole objective analysis, and I can explain it to you with another example,
sure.
is that look, if you have a simple moving average model and the market is behaving in a normal way, meaning it's trending in a normal contained way,
sure.
and you have a moving average that has a pretty decent fit, right, to this kind of activity, then it's very hard to beat that model over in that environment, because it gets you in a little bit late, it gets you out a little bit late, but it really captures the move, and it captures it very nicely.
Yeah.
Right? So that's in an environment that's sort of a normal, trendy, ordinary environment.
Mm-hmm.
The problem is when the market is not in an ordinary trending environment, and so you can try to sort of classify the various type of environments it might be, right? So one environment is in an environment where it is trending, it's directional, but the market tends to have sort of a parabolic shape,
mm-hmm.
right? So it's sort of accelerating on the upside and it's going vertical. And the problem with that market is that if it reverses quickly, the problem is that the open P&L evaporates, and the impact on the underlying volatility of the portfolio is enormous.
Sure.
Right? So you're building up this huge open P&L, and then it evaporates. It's a very bad, it's a very bad feeling, right?
So you need to reduce the number of bars that your system is looking at in that environment.
Exactly. Right. Exactly. That's right. That's exactly it. Right. So ideally, right, you want to be able to say, okay, when the market is very normal and behaving beautifully, and then you have a certain amount of bars and it captures it very nicely. Sure. And when the thing goes parabolic, right, then you want to have a more snug fit.
Yeah.
Right. So essentially, we attempt to do that. And at the same time, what we also attempt to do is this is not an attempt, it's more of a money management thing really, is that we reduce our open positions, right? We reduce our
based on volatility increase.
Exactly.
Yeah.
Exactly. So we'll look to scale out.
Sure.
Right? We'll look to scale out and take profits. And it's not because we know how to pick tops, right?
Sure.
Or bottoms. But it is really to try to deal with this underlying problem of it's really to try to mitigate the enormous volatility you can have on the portfolio in those kind of situations.
Sure. Can I ask you a question? Is the same true that if you get into range trading environment for these kind of models, that actually the best thing to do then is to increase the number of bars in order not to be whipped around too much?
I would say yes. There's an element of an attempt, right? That's yes, we try to do that. The other thing we try to do is we're actually flat. Our capital utilization is very low. We run an average around 15%, which I think is pretty low. And the reason for that is that we are out of the markets a fair amount of the time. We're probably out of the markets about a third of the time.
Sure.
And so part of it is what is sort of scenario that I just explained, but the inverse of it is what you teed up is that, well, what do you do in a sort of sideways trending, sort of choppy environment?
Yeah.
And the holy grail, right, is to stand aside and not do anything.
Sure. No, absolutely. And you can do that by combining, say, if we stay in the moving average space, you can combine 3 or 4 different, oscillators together, and obviously some will be long, some will be short, but net, you might be flat overall, and obviously that's one way of doing it. But that's fascinating. I appreciate that. That's I hope people are paying attention and making notes, because that's a real good insight from your side. How do you? I don't want to talk risk management just now, but I do want to ask you whether you use models that have hard stops, or whether you only do, as we just discussed, sort of change the parameter sets dynamically in order to perhaps control the risk better.
So Nils, I was saying on the directional models, they all have predetermined stop loss. So really, the only ones that don't are the mean reversion strategies. They don't run stops.
So tell me a little bit about mean reversion strategies in the context of what you do. What have you found that tends to work better? Because a lot of, obviously, mean reverting strategies is really known for the ones where you pick up pennies, but then one day you get run over by a train, and you're out, so to speak.
Right.
So how? And it's a little bit against the philosophy of trend following, which is interesting as well. So how do you marry the two?
Well, I think that's the attraction, right? Is that they are really opposite.
Yeah, opposite attracts, as they say.
Right, and they behave completely opposite.
Yeah.
Right, which is the beautiful thing, because the directional sort of trend following approach is one where you see the spikes, right, on the equity curve.
Sure.
Right? You see it sort of meanders around, and then you get the moves, and you see the equity curve increases sharply. Right, you see the pure asymmetrical, the beautiful asymmetrical smile of the directional volatility markets, right?
Sure.
And that's why we as CTAs, we love the Sortino ratio, right, instead of the Sharpe.
Right.
And the mean reversion are exactly the opposite.
Yeah.
Right. They're you make, and then boom.
Yeah.
you get hurt, right? Sure. And then hopefully you make again. So marrying the two has a real attraction. Now, and what we just talked about is sort of the reducing position sizing and scaling in, scaling out of the markets. For us, that is a baked in mean reversion strategy. It doesn't fight the trend, right? But it reduces trend exposure. Mm-hmm. Right, so to us it hasn't. To us, we call that a sort of baked-in mean reversion, right? Because we're taking chips off the table, and whereas a hardcore trend-following trader will ride that thing till it's going to go from 100 to 0, or from 100 to a million, right?
Yeah.
So for us in the core models, we have that baked in.
Yeah.
And then we found across the financial markets that pure mean reversion strategies, standalone mean reversion strategies, actually can work quite well. And they are, strategies that will look to, buy into weakness or sell into strength, and as you sort of explained, is that they have a high probability of success, and they take out, sort of nice chunks when they're successful, and when they're not successful, they take a disproportionately larger chunk, but they do it much less frequently, right?
Sure.
Now it's just the nature of them. But then because we trade the same markets,
okay,
on the directional volatility side, right? So if we're really sucking wind on on a mean reversion strategy, we tend to mitigate it or even make it up for it on the directional side.
Yeah,
and hence also a little bit the weighting, right? Because sort of our core is really looking for those directional asymmetrical moves.
Does performance-wise, does the mean reversion strategies deliver 30% of the overall performance? Is it that simple over time? Or how much performance do they actually attribute compared with the size of allocation?
It's that's a great question. And I can't actually answer that.
That's fine, no worries.
Directly, but
sure.
Because I haven't looked at it quite that way, sure. And I think perhaps we probably should. But I can tell you the way we do look at it. We look at it very much in the framework of the portfolio. Right. So again, like you could make a very compelling case for having models in certain markets and sectors that actually don't make money, but they have such a low or inverse correlation to all of the other activities that you engage in, that it helps mitigates the overall volatility of the portfolio, right? And therefore becomes a very valuable player. So this sort of really the way we look at it, particularly with regard to the mean reversion thing, is because when, for instance, so let's take an example. So the 2008 financial debacle and subsequent the sort of decompression in the financial markets and the lowering of volatility over a multi-year period, and sort of somewhat absence of directionality, the mean reversion models were very effective in carving out a steady return over that period of time. Right. So they really helped mitigate when you're always placing bets and looking for that directional move and it's never materializing, right? So you're bleeding, right? You keep bleeding, you're betting, and you bleed. And the directional volatility, the mean reversion models were very helpful in sort of, mitigate that.
Yeah.
And so we're sort of we look at it in that sense, right? Because we just find that they're very helpful in reducing the overall volatility of the portfolio and providing for a more steady, maybe higher confidence level of a constant sort of return stream.
Now you mentioned before, if I'm not remembering incorrectly, that mean reversion models don't have a stop. And of course, we just experienced a so-called Black Swan event in the Swiss franc a couple of months ago. I know from your newsletters that you were not involved in that, but it does raise the eyebrows when it comes to risk management on mean reversion trades, and we do know that a lot of people got badly hurt during that time. Do you not worry about not having a stop for a mean reversion strategy?
It's Nils, it's certainly worrying, and that's also why we dug in and we wanted to do some analysis post the Swiss National Bank surprise move and the subsequent enormous revaluation of the Swiss franc.
Yeah.
And yes, does it make you nervous? Does it make me nervous and uncomfortable? Yes. I think that what we try to do is as we talked about earlier, is that we're very, we talked about processes, right? Portfolio construction and risk allocation. And what we spoke about is that, we're very, we have strong beliefs about allocating a certain amount and broadly allocating across various sectors and markets and evenly allocating across them and a certain particular allocation across the various models, and the models are running across various different markets, right? So every individual single market gets a relatively small allocation, right? So if you have a blowout in say the Swiss markets, yes, you take a hit, but if you take a hit maybe of in a couple of percent or 3% or maybe even 5%, you still live to fight another day.
Sure. Now,
you can't have the kind of concentration. I mean, if we're talking about, if you're talking about long-term capital management, right, where you're talking about 30 times, 50 times leverage, and you essentially are engaged in mean reversion strategies with that kind of leverage,
right?
You go through a black swan. I mean, that's exactly what happened, right? Sure. And then you're gone.
Yeah.
But keep in mind what I told you is that our leverage is minimal.
Sure.
Right. I mean, our capital utilization rate is on average 15%. Sure. So we're trading on a leverage of maybe 2-3 times. Sure. It's tiny compared to those kind of classic mean reversion strategies.
And I do accept that. And my understanding is also, of course, that, you're taking off chips from the trend following part. So in theory, at least, you could say that you might hurt on the mean reversion trades in a situation like that. But hopefully then some of the trend following or volatility directional trades would be kicking in and help you out. So I do accept that as a concept. Although I would say, I think people forget a little bit. I mean, there was a lot of damage done in the markets for that one event. And I think people forget that was just one market. I mean, imagine if it was the euro breaking up and you had, 17 different markets going wild at the same time, because it wasn't just the currency. I mean, equities, in Switzerland got hurt significantly and so on and so forth. So, I mean, to me at least, it does it does happen more often than people believe, and anyway, I do like having these I guess very quantifiable risks, even though sometimes it performance-wise is better not to use directly stops on your positions. Anyway,
yeah. Well, I mean, look, Nils. I mean, in general, right? These kind of events are the kind of events that we live for.
Yeah, no, I agree. I agree.
I mean, that's typically when we have our best performance.
Sure. Yeah, and certainly January turned out to be just that, and I think this month is not looking too bad for most trend followers either. So, so I think there's good news on the way. I wanted to talk, I mean, we've kind of already done that sort of digressing into the risk management side, which is very important, I think, generally speaking. But I just wanted to ask you one thing, just from an overall point of view. In terms of risk, how have you found best to define risk? I mean, what is risk for you? Is it the value at risk? Is it the standard deviation? How do you quantify risk?
Right. So I think that we sort of look at it partially from a top down and partly sort of bottom up. Right. So we talked at length about sort of portfolio construction. Yeah. Right.
Yeah.
So I think that we're big advocates of having a process, right? And the process essentially embodies a almost sort of a belief in things such as it's better to be trading 8 sectors and 60 markets than trading 1 sector, 2 markets. Right. It's better to have an even allocation across many sectors and markets than have very concentrated. Right. Right. There's sort of all of those type of things that, even though you might be able to construct a portfolio and then models that are highly concentrated and show exceptional historical performance, but there's sort of still a a more, should we say, sort of humanistic decision making that comes in that says, okay, I just don't care, right? I don't care that this thing can return 1,000% with 1% drawdown over 5 years, because it's basically one market, right?
Sure.
And I'm just not comfortable building a business around trading one market. So I think that's this sort of overall viewpoint, and we embrace that, right? So, and underneath that, we try to then justify it, right? By applying the models, running the correlation analysis, and to see what the picture then might look like. And if we think that picture is an acceptable picture in terms of the sort of risk-adjusted returns and so forth. And then what we do on an individual level, when we actually place an investment, as I said, probably about, I would say 80% of the positions have a predefined stop.
Right.
And we use the underlying volatility in that particular market to determine the position sizing, which is then the overall, which is sort of a function of the overall assets under management, right? It's
Sure.
a function of the overall leverage of the portfolio and what constitute the available risk capital to that particular market.
Sure.
Right. So that's sort of how we look at it.
Yeah. I want to jump to another section that, and this one will be a brief one for you, because it's.
Milt, if I may just interrupt you on that former point.
Yeah.
Right. I mean, I think that perspective is fairly common, but nevertheless unique to our industry, right? Because if you talk to a bond manager or a stock manager or a long short stock guy, he'll tell you something very different. Right? Like he will allocate outright a certain amount of assets or risk to a particular trade or investment, and then he will do VAR analysis, and he'll do very sort of shock analysis on his portfolio, right? And he will come up with a risk profile to present to a potential investor, right? But it's just very different the way that we look at it, right? We look at it sort of as a stream of serious bets, and all of those bets we're willing to risk a certain amount on those bets, which are typically constant but across very different assets, right?
Sure. No, I completely.
It's just
agree.
that we have a very. I think this industry has a unique perspective. I mean, I just met with a potential investor last week, and we got into this discussion, and I actually found it quite challenging to explain and to justify the way that we view risk management and the amount of, how we look at it on every position sizing, et cetera, because he's from a more traditional bond investor, perspective, which have a whole different way of assessing risk.
Yeah. Did you convince him?
We'll see. I'll let you know.
Okay.
I hope so.
Yeah. Now, I wanted to jump in and ask you a little bit about drawdowns, because I think that having people talk about this is quite important, and also I think actually for investors in this space, it's very important to hear experiences. The problem with you is, of course, you haven't really had a drawdown yet. So I'm going to rephrase my question. I'm just going to drill it down to basically, a couple of questions. And that is, I know that you expect at some point to lose between 15 and 20%. That's what your research shows you. But you haven't done anything even close to that in real trading. So how do you prepare for this drawdown? Because mentally, that's going to be, a different situation to be in.
You're right. And I think Nils, that's I guess it's almost impossible to answer
Sure.
before you're actually in it, because I really do appreciate where you're coming from. Look, I guess I would say that I've in my career, a number of times I've been trading. and trading for banks and financial institutions, and trading for my own and so forth. So, I have experienced drawdowns on an institutional level as well as on a personal level.
Yeah.
And you have to really have a strong conviction. Yeah. I think actually I'll tell you a story on that. You will appreciate it, I think. As when I tried this business first time around, was early 90s, and I went to one of these conferences, and I saw John Henry was there.
Sure.
And I walked up to John and I said, "Listen, John, what advice can you give to an emerging, aspiring money manager CTA?"
Right.
And he says to me, "Do you believe in your models?" And I said, "Yes." And he says, "If you believe in your models, never, ever deviate from the models, follow them." And what he's really saying is, when things are rough and you have that drawdown, which you invariably will have,
sure,
that's when you're going to be tested.
Yeah.
And if you really believe in your models and the work that you've done, you stick to your guns and you'll do okay.
Yeah. Which kind of goes back to, I guess, what I was trying to explain earlier on about the observations about the most robust systems are actually the ones who've been through the drawdowns and, been there, done that. And I truly believe
John Henry is a particularly interesting one, right? Because he has experienced so many drawdowns and so severe ones, and invariably has managed to come back. It's pretty an amazing thing. No?
Yes, but there are a few people like that, and
you're right.
And everyone who's been around for 30, 40 years have been there and done that. And I guess, in a sense, one thing I would say, and that is, in answering the question, which I think you did perfectly, it's about your experience, because you're not the typical new CTA. I mean, most young CTAs that we see start up when they come out of school almost, and probably have very little experience to draw on, once they go through their first drawdown. But you have something which is equally valuable, which is life experience from running and managing businesses, and that's also stressful from time to time, and that's certainly no different from doing what we do. But let's just jump on to the next topic. I wanted just to touch a little bit upon, because I know we've been chatting already for a couple of hours, and but I just want to touch upon research, because clearly your son and you, Oliver, and you are doing this together. And so I can imagine that there is a few conversations over dinner about work as well. But when you're together and sort of in a research mode, what are because this, I guess, is another challenge when you have a small team, and that is, how do you challenge each other to come up with new ideas and so on and so forth. And I guess maybe the experience and the input you got from in the NYU group, will have been very valuable in terms of, new ideas, new ways of looking at it. But what's sort of the typical research conversation you have between the two of you when you sit down and talk about new things or things you want to maybe explore or improve?
So, Nels, you, as yourself, you've been in the business for a long time, and I've been in the business for quite a long time, and I've had many clients in this particular space, and I have observed so many different strategies being deployed over the years by these many successful money managers. So I would say that the list of research projects is very, very long. Actually, it is no shortage. Right. I think of research ideas and opportunities to explore. I think the issue is one of prioritization and fit. Mm. Right? Like, does it fit inside of the sort of overall, portfolio that we want to run. Right. So the idea, right, when we started introducing these mean reversion models is because we knew that the underlying behavior of a mean reversion model was essentially directly the opposite of, directional trend models.
Sure.
And so before we started, we thought, it's kind of, pretty cool if we can have an edge on both sides of that equation, right? If we can have an edge and then combine them, if things match up perfectly, which they might, more or less,
sure.
Then you should get a better risk-adjusted return, right? And then you can essentially lever your portfolio proportionately, and you should be able to extract somewhat better returns relative to the risk that you take.
Yeah.
Right. So I think it's sort of along those lines, is that you sort of imagine what a particular strategy, what it might look like, and how it might fit into your overall portfolio, and if it adds not just return, but what's the underlying correlation of that idea.
Yeah.
And if it's somewhat invertly correlated or low correlated, it becomes an attractive proposition. So I would say, we have a long list of of ideas. The thing is that to develop an idea and to thoroughly construct it and to thoroughly stress test it and to thoroughly get it to a point where you believe that it's robust and it can be introduced, it actually takes a long time. And I've discussed this with my son, and I've challenged him to say, look, if you can come up with a new idea and sort of a fully flushed out idea and model once a year, I think that would be a great objective.
Sure.
But I think I think it takes at least that.
Yeah, and speaking on that topic a little bit, and that is something that I often get asked by the listeners, and that's actually the converse situation, meaning how do you know that one of the models you already have in the portfolio has stopped working?
Okay, so we monitor, right? We monitor the theoretical performance and the sort of a historical profile on a real-time basis with the live models, and we look for any sort of deviation that from the sort of expectation and the expected behavior and profile. Now that's more prevalent and obvious on the shorter term models, right? Just because the velocity of trades are much greater. And it's somewhat less on the longer ones, much less on the longer ones. So I think actually the longer ones, when you're sort of talking sort of, core, right, sort of directional trend, more traditional type models, it's almost impossible. It's like basically you either believe that this thing is going to work over time or not. It's very difficult to monitor. On the shorter term models, you get a lot more data points.
Sure.
And you can observe it sooner.
Yeah. One of the final topics I also want to touch on is just a little bit on the business side, and it's kind of random, the questions that I sometimes pick depending on how our conversation have been so far, and I think we've touched on so many things already. So I just want a question that I actually think is relevant for managers to consider right now and for investors to be aware of as well. And since you mentioned that you are moving towards having a fund, you're launching your first fund, you're mentioning that 15% of the money you get in your fund will be put to work through margin on average. But that leaves you with 85% of the cash. And in a zero interest rate environment, where potentially there could be some significant risk, maybe not obvious to the eye in the fixed income markets at these historical low interest rates. What are your thoughts about what you're going to do with the 85% of the money that you don't need for managing the new fund?
Yeah, Nils, that's a real conundrum. And, historically, it has been one of the areas that have actually added a very nice cushion and a very consistent return profile to our business. Because typically the money management business is the inverse, right? Typically it requires leverage. Right, and therefore, so you have actually a cost of capital. Most investment strategies have that characteristic, and ours is the opposite. and it's a beautiful thing, right? Because historically, you could put the money into a T-bill, and you could pick up a couple of percent returns, or back in the 80s, maybe 5, 10, a lot of really good returns with hardly any risk. So you're right. What do you do today? Because there's no return to be had, and actually, if you are in euro or you have an inverse, you have an inverse problem. So it's costing you to keep the money in cash. So what do you do? So what we have done is we think there is decent value and decent stability in short-term corporate bonds. So we've actually put monies in short-term corporate bonds, sort of 1 to 3 year duration, and we've essentially bought some ETFs. And they pick up a couple of percent or so, and we think that's a reasonable area. The corporate America is doing quite well, and maybe you could argue that there's less risk in corporate America than there is in
government America.
Exactly, and at least you get paid a little bit for owning those papers. So that's sort of where we put the monies, but we haven't invested up to the sort of full 85%. And I would say we are more we've been very patient to deploy that. In other words, sort of we've been sort of had a mean reversion perspective on that. If they dip a little, then we'll buy some.
Yeah, no, absolutely. Now, you're an interesting point in your business because you already have probably had lots of conversations with potential investors, due diligence meetings, due diligence phone calls, and no doubt there will be many more to come. I wanted to ask you what your observation is so far in terms of those conversations. What are the questions that investors should be asking you, but they're not? Do you know what I mean? I mean, what should they really drill down in to understand what you do, yet they may not actually go in that direction in the way they phrase the questions they have for you?
Right. So,
or what should they be asking, I guess, is the short way of saying it.
Well, I would say, look, I haven't had all that many conversations because, I think I like to think, I hope that we are sort of at an inflection point where more investors are going to be sort of interested to learn a little bit more about what we're doing. Whereas up until this stage, I would say the majority of communication has been sort of one-sided, in terms of providing information, as I told you, through monthly newsletters and illustrating, how we're trading and so forth and so on. Although we have had conversations, but most of the conversation we've had, I would say, are with these early adopters, right? So besides, family, friends, business associates, right? Which have a certain emotional component in terms of why they give you the money, right?
Yeah.
Now we're sort of into the category of say, the early adopter, and the early adopter is very savvy.
Yeah.
Right? They really, really understand the space, and they grill you, left, right, center, and all around. So I'm not sure that they really leave any stone unturned. Sure. They're pretty thorough. Sure. And so I think that when you get into sort of the broader investor base, let's say family office, small institutional clients who are not entirely, exclusively focused on investing in this space. Well, look, I would say, I mean, the thing that I stress, right, is this idea of, this is an attractive potential return stream. It's an attractive risk-adjusted return stream, and perhaps another very attractive component is it has a very low correlation to your traditional investments in stock, bonds, and say real estate, right? And so that's a very attractive high-level situation. And I mean, I actually think the less sophisticated you are, the more basic the conversation is. And I actually don't think there's anything wrong with that. Meaning, the investors should understand what is my risk, right? So we talked about at some point, do you pull the plug, right? And I say to the investor who sort of is not a professional in this space, I say, listen, your risk, your initial risk is max peak to, if you go in at the worst possible time historically over the last 34 years, maybe you could be down 20% of your initial investment. You have to be willing to stomach that. Yeah. We think that we can mitigate that risk over the first 12 to 18 months. We think that, right, because our targeted return profile is somewhere between 15 and 25% annualized, right? Sure. So I will say to an investor, listen, if you can hang with us for 12 to 18 months, we think we can mitigate most of that initial risk. Yeah. And in many ways, I mean, Nils, I think, the simpler you keep it, sort of the better it is, because you can just very, very easily get lost in a lot of sort of intricate details that are very interesting to you and I, but to an investor, it just sort of glazes over the eyes, and then the risk is it goes into a category of, I just have no idea what they're talking about. Sure. I don't understand it. It makes me uncomfortable, and I'm not really going to do this,
Yeah. And I do agree that many of the early adopters, they are pretty savvy and they ask good questions. So I think that's right. I'm going to jump to the last section, Kim. We're almost there. There's light at the end of the tunnel here. And it's one of my favorite categories or sections, which is the one I call general and fun. So not a lot to do specifically with any models or systems, but just something that gives people a little bit of color and hopefully one or two good insights to take away as well. I wanted to ask you, just to start off with, I mean, you tried a lot already in your career, and along the way you may have read, a few books that have guided you to take some of the decisions that you've taken. If you're going to recommend a book or two for people to, could be either improve their trading or improve their business, which books would you say have had the most impact on your career?
So, Nils, I've been around for a long time, and I've read quite a few books, and sort of the early books, right, was the Wells Wilder, some of the Larry Williams books. Jack Swagger, sure, of the top traders, right, was always very inspiring and interesting. I think there's a more recent book called The Quants, and then there are sort of a little bit more specific books that are sort of more detailed around, is it Ralph Vince that goes into, the optimal risk in a portfolio and so forth. And they get much more technical in nature, right? So I would say it depends a little bit sort of where you are, yeah, right? If you're looking for an introduction and you want to understand this business sort of from a little bit more general and a higher level, and you want to get inspiration from other people who have succeeded in the space, Jack Swagger's book is, books are probably some of the best. Yeah. And then I think that, if you sort of if you really seriously and really on the professional levels, I think it's good to read a lot of these books, but I think you have to toss them out, right? You just have to toss them out, and you have to sit down and you really have to think critically about the markets and the microstructure and how they work and the psychology around the markets and why markets behave the way they behave. And then I think you have to think about how to capture that behavior, mathematically, through sort of logic, right? And then you can maybe you can sort of go back into the toolkit, right, into the books and stuff, and you can go in and you can maybe extrapolate out maybe a data or a concept, and you can say, okay, how can I use that tool to try to solve this issue, this opportunity, to uncover this opportunity, right? Can I use that, or do I need to come up with something completely new to try to capture this idea? Right? So I think that's where you. I think that's where you want. That's got to be if you want to. If you want to be in this space at the cutting edge, and you want to compete, you have to be somewhat original. Not completely from scratch, but you have to be somewhat original in the way that you construct your models and the way you try to solve the problem of extracting earnings.
Sure.
It's if you could buy something off the shelf, right, and just plug it in and off you go, then that's just not quite realistic.
Sure. Sure.
But there are also a lot of components, right? I mean, there's so many sides to this business, right? I mean, you could develop an incredible alpha model, but if you don't understand the risk components, like how to manage the risk, or if you don't understand how to construct a portfolio properly, then you're probably not going to be very successful.
Sure, no, that's true.
Right. So there's so many different components, and I think a lot of the books will help you think about all the various different areas that you need to consider and that you need to incorporate into the management of investing, trading in the markets, and building portfolios and managing monies. But in the end of the day, you have to think about it critically yourself, and you sort of have to construct it from that vantage point on.
Sure. It sounds like on my side, unfortunately, we're losing a little bit of our crisp connection here. So I'll try and wrap up with the last few questions before we lose the Skype connection entirely. But I wanted to ask you, as you build your business, are there any other CTAs, bigger ones, that you look at for, to aspire to? I mean, are you looking outside and saying, Prolific Capital, I would love for them to be like so-and-so in a few years' time?
Right. So, look, I've had many of the successful CTAs as clients over the years. And I know that one of the clients you interviewed, whom I think is really brilliant and sort of an original thinker.
I can guess who it might be.
You want to guess before I say?
My guess would be Roy Niederhofer.
Yes, you're right.
Okay.
Exactly. So Victor was a client of mine early on. His brother and Roy and Victor worked together back then, and they were clients of mine. And I had a lot of interaction with them, and they're just really original thinkers, independent thinkers, right? Yeah. So I think that's very aspirational, and I think it's really pretty cool what they do. Yeah. Somebody who came out of that group, who was also a client of mine, who was extremely successful, was Trout.
Right.
Monroe Trout.
Sure.
So very interesting. I had encounters with, as you know, with Paul Tudor Jones.
Yeah.
and he's also subsequently been client and so forth. And it's just a very, very inspiring, sort of background.
Yeah.
Where he comes from as a cotton pit trader and developing the business as successfully as he had. Bruce Kovner, right? There's a lot of these guys that are really quite admirable in terms of how successful they've been. So I think there's a this is sort of to aspire to any and all of those guys. It's pretty cool.
Sure. Well, with those connections, Kim, feel free to invite them to come and talk to me on the podcast.
I'll give it a try. No problem, Nils.
Now, clearly, your son Oliver works with you. You have 3 other children, as you mentioned. If you could pass on just one of your own skills to your children, what would that be?
Interesting. Okay. Well, I think that in life it's a very good thing. It's a good quality to be open-minded with a sort of a positive perspective, and I think that in life you want to try to position yourself for success. Whether that is in your professional vocation, personal relationships, if you are competitive in sports, or if you are in this business, which is a competitive business, you want to be open-minded and positive, and you want to be able to take in whatever comes your way in life. You want to take it in with an open mind and with a positive perspective, because when you do that, your brain has a much greater capacity to process those inputs and to organize them and position themselves, or you can position yourself around it for the most successful outcome. So if I were to pass on something to my children, I would say, keep an open mind, a positive mind, and use those circumstances to position yourself for future success.
Great advice, Kim. Now, can you tell me, before we sort of round up, can you tell me a fun fact about yourself, Kim? Something that even people who know you, may not know about you?
I don't know if anybody would classify me as a sort of a super fun guy.
No, I didn't mean necessarily that it has to, that you know that you do stand-up comedy in your spare time, but something. Right. It could be a talent, could be something that even people who are around you may not know. That you enjoy doing or not enjoy doing, for that matter.
Okay. So I actually didn't mention this, but since we're having this conversation from your home in Switzerland, I believe, right? My dad is in Geneva and my brother is in Geneva and Switzerland, and my brother is an avid polo player,
right? And
so when I go to Geneva, invariably he convinces me to get on the top of a horse and play a few chukkers with him. So a secret is that I grew up on a farm in Denmark with horses, and I actually at some point trained race horses. So I do know how to ride. It's not something I do every day.
Sure.
So you can imagine the challenge of going over for a periodic visit.
Sure.
Get on top of as an Argentinian polo horse.
Right.
And playing a few checkers in Geneva with the Geneva Polo Club is kind of a interesting thing.
Absolutely.
And I guess a comical thing when I land up on the ground.
That's where the fun part comes in, or the fun factor comes in.
That's it.
Yeah, I hope people got caught that, because I can hear on my side that our connection is breaking up. But before we finish, and this will then be my last question, I said earlier that I think it is important that investors ask the right question. So I'm also going to turn it on myself and ask you, if I missed something today in trying to cover all the ground about you and what you do with Prolific. And if there's anything that we need to cover towards the end here in order to do justice to you and your firm.
Nils, I thank you very much. I think you've been super thorough. Normally, with most people, it's an elevator pitch of 30 seconds and you're out the door.
Sure.
So having the opportunity to talk about what we do for an extended period of time, I think we've covered a lot of ground and a lot of detail, and I appreciate that. Look, there are other things we can talk about, but I think that you covered by the vast majority and gave hopefully our listeners a good insight into what Prolific is all about.
Sure. Absolutely. And of course, we have to thank Mark Goodman for making the introduction. Most people will know Mark as one of the founders of Kenmar back in the day. So I want to put that on record. That was very kind. And this has certainly been a great conversation, not just because we have our Danish history in common. It has been enlightening. It has been, I think a lot of people can take a lot away from this conversation on many different aspects. So I really appreciate that. I appreciate your willingness to be transparent about a lot of things, which is something that not everyone is comfortable with. So with that in mind, Kim, I want to say, thanks very much. And I want to ask you where people can best find you and learn more about Prolific.
Well, we're located in New Jersey. Mm-hmm. We're located in New Jersey, and I guess the best way to contact us would be through email. Sure. And you can reach us on kbang@prolific-capital.com.
Great. And of course, I will put all of these details in the show notes for this episode on toptradersunplugged.com. So I hope we will be able to connect later in the year and hear about the great work you're doing. And of course, at some point, perhaps even introduce Oliver to the podcast as well. So all I have to say now is thanks so much, and hope to speak to you later.
Thank you very much, Nils. Thank you for your time.
You're welcome. Take care. Bye-bye.
Bye now.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.